Our graduates need guidance. They are getting questions right now from people who are desperately eager to know, what do I do with my portfolio? At a turbulent time like this, how would you help them frame that answer?
If the original investment policy statement is sound, and the research that went into designing that statement and working with the client and establishing the client's risk tolerance, then the only advice is you have to stay the course. You have to stick with the plan.
But my numbers are going down. The Dow is tanking. It's a good day, it's a bad day, but the clients are nervous. And here they are in their late 50s or late 60s, and they're saying, I don't know if I'm willing to gamble on that notion of hang in there. How do I help overcome that objection?
Well, there's two ways to think about that one. One is we know a lot of people who are approaching retirement now have not adequately saved. And if you've not adequately saved to start with, and your portfolio has gone dramatically south, and you pick now to convert from stock holdings into mostly or completely bond holdings,
or cash,
or cash, then there's no question that you're going to be completely inadequately prepared for retirement.
What does history tell you? When you were trained as an economist, what does history tell you about what people tend to do during panic moments?
Well, by definition, in panic moments, people are panicking, and there's lots of evidence to me that there is an incredible amount of panic going on right now. The dramatic drops in the market, the short but dramatic upturns that we've seen. When you get surges in selling and surges in buying like that, it can only be that people are trading based on emotion. The person who suffers the most in a panic like this is the fellow who sells at the bottom, and most people most people fear regret more than they appreciate the pleasure of gain, and it's difficult to think of anything that provides more regret than realizing you cashed out at the bottom. So panicking and cashing out at the bottom is a sure way to feel pain the entire rest of your life, maybe much more pain than if you had ridden it a little further down and then ridden it back up.
Excellent. Let me ask you about this. Life insurance is one of those products that is very hard to sell in a good economy. It becomes an extraordinary effort when money is tight for a family or for a business owner. And yet I've had so many people say in recent months, this is the time when you actually need life insurance more than ever, when this industry should be on fire. How can an agent be more effective in helping the family understand they're more vulnerable when times are tough?
One of the central marks of life insurance is that cash surrender value that builds up. And it's important to think about that cash surrender value as kind of the centerpiece of a retirement plan. And to the extent that you can buy a life insurance policy, it would provide sort of the starting point of a portfolio. And the other issue is if times are tough now and the breadwinner passes away, times will really be tough. It really brings up images of the 1930s and how people suffered.
Are mutual funds a smart place for people to park their money during a volatile economy?
Well, you have to remember, mutual funds are not really a unique investment compared to stocks and bonds. Mutual funds and ETFs are simply vehicles that allow people to invest in stocks or bonds or both in a manner that gives them instantaneous and incredible diversification with relatively small amounts of money. So is it a time to put money in mutual funds as opposed to stocks or bonds? Well, that question doesn't really make sense because they are one and the same thing. Is it time to be in the market? Yeah, I think it's always a time to be in the market.
When you look again at history and events over the past couple of months, how extraordinary is this?
I would rate it as somewhat unique, but not completely unique. For example, we recently had a day where the market went up the Dow went up almost 1,000 points. and you look at that and you say, wow, this is truly a unique period of time. But actually it turns out that that was only the 5th largest percentage one-day increase in the Dow Jones Industrial Average over its history. So we've had 4 other days in which, in percentage terms, the market went up substantially more, and the biggest single-day increase was back in the 1930s. So, you know, it is unique, but it's not that totally unique. And if you go back well into the 19th century, you will find periods just like this, traditional panics in which there was sudden, rapid loss of wealth.
This industry right now is at the apex of an incredible storm. The criticism and the suspicion about the financial services industry is going to continue to be very strong in the months and certainly the year ahead. You have a chance, you personally have a chance to step to the plate, talk with your clients. Recently, I came across this letter that you're seeing from Dennis Manning, the CEO of The Guardian. It's a wonderful statement in which basically The Guardian was reassuring their policyholders that they had no reason to be concerned. Have you picked up the phone and called your clients? Have you sent out an email or a letter to your clients? That's what Dr. Solomon Huebner, the founder of the American College, would expect from you. That's what we expect from you. And more importantly, I think it's fair to say that's what the public needs from all of us. So there is no such thing as over-communicating during turbulent times. Thank you very much for joining us.